Every market crash feels different, but psychologically, they are all the same. Prices fall, headlines scream, experts panic, and suddenly, smart people do very irrational things. Why? Because market crashes are not financial events. They are emotional events, and the market is just the scoreboard of human fear. The illusion of control. When markets are rising, we feel intelligent. We believe our success is skill. We believe we understand the system. We believe we are in control. Then the crash comes, and control disappears. In reality, we were never fully in control. But rising markets hide that truth. Falling markets expose it. A crash doesn't create fear. It reveals it. Loss aversion. There is a powerful psychological rule called loss aversion. Losses hurt about twice as much as gains feel good. If your portfolio goes up 20%, you smile. If it goes down 20%, you panic. Same number, very different emotion. And during crashes, your brain stops thinking in decades. It thinks in survival. Your brain does not care about long-term returns. It cares about stopping pain immediately. Media amplification. Crashes don't happen silently. They are amplified. Red charts, breaking news, urgent notifications, markets in free fall. Worst drop since. Investors terrified. Fear spreads faster than facts. And repetition creates perceived truth. The more you hear that things are collapsing, the more real it feels, even if nothing in your long-term plan has changed. Herd behavior. During crashes, people don't think independently. They look around. What is everyone else doing? If others are selling, it feels dangerous not to sell. Humans evolved in tribes. Being alone meant risk. So psychologically, following the crowd feels safe. But in markets, the crowd often moves at the worst possible time. Panic selling feels like protection, but it often locks in loss. Time horizon collapse. In a crash, your time horizon shrinks. An investor who said, "I'm investing for 20 years," suddenly says, "What if this never recovers?" The brain shifts from long-term strategy to short-term survival. But historically, every major crash has felt permanent while it was happening and temporary in hindsight. Identity threat. A crash doesn't just threaten your money. It threatens your identity. If you see yourself as smart, disciplined, rational, a crash challenges that story. It forces you to confront uncertainty. And uncertainty is uncomfortable. So people act, not because it's logical, but because action reduces anxiety. Even bad action feels better than no action. The hidden opportunity. Here's the paradox. The same fear that drives people out of the market creates opportunity for those who stay. Crashes reset valuations. They transfer assets from the impatient to the disciplined. But discipline during a crash isn't about intelligence. It's about emotional regulation. It's about remembering. Volatility is normal. Fear is temporary. Time is powerful. Historical perspective. Every crash feels like the end. The Great Depression, the dot-com bubble, the financial crisis, the pandemic crash. Each time, people believed, this time is different. And each time, eventually, the market recovered. Not instantly, not comfortably, but eventually. The long-term trend has always been upward because markets reflect innovation, productivity, and human progress. Calm power. A crash is a test, not of your portfolio, but of your psychology. If you prepare emotionally before volatility comes, you don't need to predict the crash. You just need to survive it. Because in the market, time rewards the patient and punishes the reactive. The next crash will come. It always does. The question is not, will it happen? The question is, who will you be when it does?